Welcome to the Max Dividends channel, where people build growing passive income, retire early, and live off dividends. In every video, one stock is broken down in detail, from business model to financial metrics. If this sounds interesting, definitely subscribe. Many exciting analyses ahead. Today we're examining Grainger, GWW, industrial supply and MRO distribution leader. We'll answer, how does this company make money? Is it good for long-term holding? We'll go through Max Dividends checklist step by step, check financial condition, see if it fits our plan, and determine if the stock is undervalued today. How this company makes money. Grainger distributes maintenance, repair and operations, MRO products, to businesses and institutions, earning margin between sourcing costs and customer pricing, combined with fast fulfillment and growing digital ordering engine. Core revenue engines include high-touch solutions for large enterprises with dedicated sales coverage and inventory programs. Endless assortment online with expanded SKU breadth, capturing orders efficiently. Distribution logistics network, providing speed and product availability. Adjacent services like inventory management and procurement tools, deepening customer relationships. Grainger sits at intersection of industrial activity and non-discretionary need to keep workplaces running. Proven MRO distribution platform with recurring replenishment demand and improving digital leverage. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter, companies with 15 years of consistent dividend growth. Grainger shows clean stair-step pattern with annual payout climbing from roughly $2.5 per share in early 2000s to about $8.8 most recently. Steady, uninterrupted growth with no cuts, no freezes, just consistent upward progress. 56 consecutive years of dividend increases. Step 1 passed. Grainger behaves like true Dividend Eagle, with long track record reflecting resilient business and shareholder-friendly management. Step 2. 5-pillar secret formula. First pillar, sales growth. Revenue rising from around $10 billion mid-2010s to roughly $17 billion most recently. Long upward slope without dramatic swings. Growth driven by essential reality that facilities need constant MRO supplies to avoid downtime. Digital capabilities and scaled distribution network drive share gains. No air pockets, sales keep marching higher. Sales growth past, consistent expansion reflects resilient distributor with repeat purchase economics. Second pillar, profit growth. Profit expanded from roughly $4.0 billion to about $6.7 billion with noticeable step-up in second half of decade. Digital ordering and optimized distribution improved operating leverage. Profitability stays resilient with overall direction up. Recent years hold close to peak levels. Profit growth past, expanding profit base strengthens dividend safety and supports continued raises. Third pillar, net income. Net income rises from roughly $0.6 billion to about $1.9 billion over 10-year window. After couple softer years, profits re-accelerate and reset higher, holding near peaks. Converts meaningful sales into real bottom-line earnings funding, dividend increases and buybacks. Net income past. Durable, rising earnings power backing dividend growth. Fourth pillar, dividend payout safety. Payout ratio started around high 40 range, then trends materially lower to roughly 20 to 25 area in recent years. Dividend well covered with plenty runway for raises without stretching finances. Management retains ample capital for reinvestment while rewarding shareholders. Dividend payout safety past, low, improving ratio signals, dividend built for durability with significant growth room. Fifth pillar, debt burden. Debt ratio in narrow band, roughly mid 0.6 seconds, drifting lower toward high 0.5 seconds, well below stress levels. Management supporting operations, dividends, repurchases while strengthening balance sheet. No debt load crowding out shareholder returns. Debt burden past, moderate, improving leverage giving financial flexibility. Company financial condition. Grainger achieves financial score of 99. Elite reading signaling very safe company. Scores above 90 indicate balance sheet strength, earnings consistency, cash generation profile comfortable owning through market cycles. By 5-pillar formula, Grainger ranks as one of most dependable dividend growers. Steady sales expansion, rising profitability, conservative payout ratio, controlled debt profile. Step 2, passed overall, proven Dividend Eagle clearing each quality checkpoint. Does it fit our plan? Max ratio 1.75 places Grainger in Growth Eagles category. With 0.85% yield, 49% cumulative 5-year dividend growth, 56 consecutive years increases, 23.52% average payout ratio. Designed to compound capital first while dividend grows consistently. Current yield not high, but rapid dividend growth and conservative payout create long runway for future increases. Fits investors wanting high-quality compounder for capital appreciation while dividend checks quietly step higher year after year. Is the stock undervalued today? Cheaper than competitors? Fairly valued versus peer group per Max Dividends app? Not paying clear premium but not getting deep discount? Cheaper than its own history? Expensive versus own 10-year average? Current PE 29.94 versus typical 24.46. Market assigning richer valuation than usual. Better yield than usual, yield below average. Currently 0.87% versus long-term 1.45%. Lower starting yield because share price appreciated faster than dividend. Analyst consensus. Moderate upside. Trades around $1,047. Analyst target $1,070, implying roughly 2% upside. Final decision. Grainger delivers quality, 56-year dividend streak, revenue $10 billion to $17 billion, profit $4.0 billion to $6.7 billion, net income $0.6 billion to $1.9 billion, payout 20 to 25%, debt mid 0.6 seconds to high 0.5 seconds. Financial score 99 confirms elite strength. Fairly valued versus peers, but expensive versus own history with low starting yield. Elite quality at full price rather than on sale. Watchlist candidate not immediate buy. If valuation cools or yield moves higher, becomes front-of-line candidate for growth-oriented dividend portfolios. Subscribe for more analysis. This is not investment advice.